Good day. This is the first of a four-part series dealing with the leverage and capital structure of companies. This first part will then focus on leverage, and then the rest of the sessions will focus on the capital structure and different approaches around the capital structure. Now, the capital structure is the mix between debt and preference shares and then equity in a company. So the sources of funding that they're using and how they then put the ratio together so that they've got the optimal funding structure for the business. The cost of the capital and the cost of each one of these sources plays an important part in the total cost of the company and what the returns of the company is. The lower the cost of the capital, obviously the higher the company's valuation, keeping everything else constant. And we are therefore looking to find the optimal capital structure, because if a company like Ford have a optimal capital structure and they can find that optimal capital structure, then they will maximize their returns. And we look at Ford International, and they at the end of 2015 had a 70.4 debt component of their capital, and the other about 30% was made up of equity, and that was compared to the about 55% of debt that a company like General Motors in America used. So therefore Ford was much more highly geared than General Motors, and you might recall from previous sessions that the more geared you are, the more debt a company uses, the higher the returns often of the company, but it simultaneously brings along higher risks. So what is leverage? Let's just define that for a start. It is using debt to increase the shareholders' returns, and that is because of the additional funding that's available in the business on top of the equity, and that enables the business to then operate at a higher level. And because they're operating at a higher level, they've got more money for stock, they've got more money for operations, and that then brings along a higher return. And the higher return, if you compare it then to the equity that's in the business, it increases the return on equity. There are two types of risks that we need to consider. The first one is the business risk, and that's the nature of the business operation itself. So that's the operational part of the business. That's the production part in a company like Ford. It's the production part of the company, and how they then sell the products, so producing it, selling it, and the important elements that plays a role here are therefore the variable cost and the fixed cost, and the magnitude of these two components in the business. So the higher the cost structure, the riskier the business, and obviously if you can run the business at a low cost structure, then the risk is fairly or significantly lower in the business. And then financial risk, that is the risk that relates to the financial structure of the company, so where they source their funding, and the more funds that's raised from a debt perspective are often contributing to the financial risk of a business, because they've got debt obligations and elements that they need to meet to service this debt. And then the total leverage of a business is then a combination of the operating as well as the financial leverage in a business. So let's start with operating leverage. Operating leverage, we said, was the operational profits of the business, and that is defined by the earnings before interest and tax. And a simple statement of financial performance, if we look at this structure, it is to calculate earnings before interest and tax is sales revenue minus the variable cost, brings along the contribution, that's a contribution in the business, less the fixed cost gives us the earnings before interest and tax. The starting point on this table is in the middle on the 1,000 sales, 1,000 units sales. So let's say the sales price is 40 Rand. So 40 Rand times the 1,000 gives us a sales revenue of 40,000 minus the variable cost, which is 20 Rand per unit, and giving us a contribution of 20,000 Rand minus the fixed cost, and that leads to a earnings before interest and tax of 10,000 Rand. If the number of units are then increased by 50%, let's redo the calculation. So a 50% increase in units, keeping all the fixed and variable cost per units the same, that results in a 60,000 revenue, 30,000 variable cost. But important to see, due to the nature of the fixed cost amount stays more or less the same. Remember, the fixed cost, and the definition of a fixed cost does not mean it does not fluctuate. It means it's always there. But let's, for the purpose of this, assume that the amount is more or less the same. So therefore, the earnings before interest and taxes increased from 10,000 to 20,000. So here we can see that an increase in sales of 50% leads to an increase in earnings before interest and tax of 100%. Why is that? It's because as the business grows, but the fixed cost stays the same, the burden of the fixed cost on the business it becomes less proportionately to the rest of the operation of the business. And that is what we want to calculate when an operating leverage is calculated. So let's continue and look at the calculation of the operating leverage. Okay, the degree of operating leverage, there are two formulas that can be used. The first one deals with a percentage, and the second one with a base sales level. But what do we want to achieve? It is the change in the sales, the change in operating income that is caused by a change in sales. So what is the change in sales converting into a change in the operating income? So the general rule is, if there is a low fixed cost to variable cost ratio, so the fixed cost is low in terms of the operation of the business, then the operating leverage will be low. And the opposite is also true. If the fixed cost portion is high compared to the variable cost, that will bring about a high operating leverage. So referring back to the previous numbers, degree of operating leverage as a percentage, and the formula is the percentage change in earnings before interest and tax that is caused, divided by the percentage of change in sales. And you'll remember the percentage change in sales was 50%. It led to a 100% change in the earnings before interest and tax, and that gives us a degree of operating leverage of 2 or 200% converted to a percentage, because that's the percentage ratio that we calculating. So there's a 200% effect. So a 1% change in sales will bring along a 200% change in the earnings before interest and tax. A base level calculation, that's dealing with the actual numbers, and again it is the contribution and the contribution is calculated by sales minus variable cost, and it's divided by the earnings before interest and tax, and again confirming the degree of operating leverage as 2. Moving on to the financial leverage. Financial leverage looks at the impact on earnings per share that is affected by a change in earnings before interest and tax. So what is the interest? But if there's a change in interest, earnings before interest and tax, what effect does that have on the earnings per share? And in this examples, whether we go up or down, you can see that if there's a 20% change in the earnings before interest and tax, it leads to a 100% change in earnings per share. Formulas is again a percentage and a base EBIT level calculation. Percentage change is the change in earnings per share that is caused by a change in the percentage change in earnings before interest and tax. And from the previous numbers, 100% divided by 20%, that gives us a factor of 5, or 500% effect. The base earnings before interest and tax level, again, it's the earnings before interest and tax divided by, and just be careful on these numbers, it is the earnings before interest and tax minus the interest minus the tax adjusted number of the preference dividends. And so you can't read that off the financials. You need to do this calculation, and I'm just going to repeat it. It's the earnings before interest and tax minus the interest minus the tax adjusted preference dividends, and that is the 10,000 divided by 2,000, and again confirming the factor of 5. So now we've got the degree of operating leverage and degree of financial leverage. So what is the total impact on the business and the total impact on our leverage? So combining these two effects, so this is the full effect now, and we start with the sales revenue. You might remember the 40,000 sales revenue, run right through to the earnings before interest and tax of 10,000 and the earnings per share of 1.44, and there a 25% change in sales revenue will lead to a 50% earnings before interest and tax, and an increase of 250% on earnings per share. So the formula for degree of total leverage is therefore a percentage on the percentage side. It is the change in earnings per share, the percentage change in earnings per share that was caused by a percentage change in sales. So a 25% change in sales led to a 250% change in earnings per share, and that is a factor of 10 or 1,000%. And at the base earnings before interest and tax level, it is the contribution divided by the factor that we calculated in the previous formula, and again confirming that it is 10. The further aspect here is if we want to calculate the degree of total leverage, instead of redoing all these calculations using these formula, we can just take the degree of operating leverage, multiply it with the degree of financial leverage, and you'll remember the numbers of 2 in operating leverage, 5, factor of 5 in financial leverage, and that gives us the 10 again. So that brings us to the end of the first session, The next session will deal with the capital structure and specifically the traditional